We're convinced volatility is going to pick up from the doldrums of the last year or two. And last week was just a glimpse of what this could look like. Not only have we got this global bond rout causing headaches, but the recent tariff headlines that we've seen and Trump's tweets, their impact on market volatility is just a taste of things to come as well. So, I think it's time to strap in for some extended volatility.
This is Converge, a podcast from Canberra. Come with us as we shape the future of finance.
Welcome back. It's the Converge Market Update, January 14th, 2025, 2 weeks into the new year. I've got George Vessey with me from the UK. Great to have you, George. It's obviously been a fairly turbulent last year, 12 months. People will be wondering what this year holds in store, and we've talked about that a lot on this podcast with you and Boris and Steve. It's that time where it's really not uncommon to see calls by analysts for the year ahead sort of becoming obsolete. So what's your take on the first couple of weeks of 2025, given what you've seen in terms of the macro and market developments? And should we be anticipating a shift in the narrative like we saw this time last year? What are you thinking?
Hi, Alex. Happy New Year. Good to be back.
Happy New Year.
Like you said, this time of year tends to be when playbooks are ripped apart and rewritten by analysts and investors. Like last year when we had 6 Fed rate cuts being priced in and a US recession was on the table and a weaker US dollar. That got all turned upside down as we saw last year. This time around, we haven't seen that unfold per se or just yet, but rather a change in narrative that took hold late last year after the US election has extended into the first couple of weeks of this year. The so-called January blues, they followed on from the non-existent Santa rally in equities that we saw in late December. We've had bond yields continuing to rise, the US dollar extended to multi-year highs, and of course the ongoing political uncertainty that remains elevated. And as a result of all of this, the market environment is becoming much more volatile. And we think this is going to be the name of the game for 2025, a rise in volatility in equities and bonds, but potentially more so in the currency space, given that FX volatility has been so subdued for a couple of years now. And in fact, Alex, the most important big picture development that everyone's talking about and does have far-ranging consequences like generating FX volatility, it really has to be this rise in bond yields across the globe that we're seeing. Because if you think when the Fed and other central banks started cutting interest rates last year, most strategists like ourselves, to be honest, we were calling a top in yields and expected rates to trend down from that point. But that's not what's happened at all. In actual fact, since October, yields have been on the march higher, despite major central banks like the Fed, the European Central Bank, Bank of England. They've all been cutting interest rates. And you could say that this is the markets trying to signal that Trump being elected has changed everything and there's no room to cut rates because inflation and budget deficits are on the rise. So, as a result of this, we have seen the probability of a pause in rate cuts by the Fed over in January, March, May. The probabilities are so high that it's become the Wall Street consensus. So this has been like the main talking point, I suppose, across markets so far this year. And I think it is supporting a sort of shift in the narrative towards a more volatile 2025 compared to 2024.
Yeah, interesting. So what's really driving the rise in global bond yields, and what are the repercussions for the broader markets, like the repercussions on currencies specifically?
Yeah, well, I think we've got to look at the US Treasury market. That's leading this reset higher in borrowing costs. And weirdly enough, like I said, the first rate cut by the Fed last September actually signaled the bottom in Treasury yields, like I mentioned earlier. So in actual fact, the US 10-year Treasuries are up 100 basis points since that point in September. And this is a jarring disconnect that's had a few precedents in recent history. And why are we seeing this? Well, rather than a slowing economy and cooling inflation, the US economy just continues to power ahead. It's outperforming its peers. Last Friday, we had another blowout jobs report, once again, providing the latest evidence of that. The 3-month moving average of jobs growth now in the US is now at a healthy 170K. The unemployment rate fell again. Wage growth is steadied. So the labour market does remain resilient in the US. But then some added data, we had services PMI for the US that came in hot as well. And the rise of the prices paid subcomponent, that caught our attention here, as it could mean that these reflationary pressures are starting to build back again. So as a result of this, the Fed is certainly rethinking the timing of further interest rate cuts. And as a result, markets are only pricing in one rate cut by the Fed later this year. And that's one reason why it's driving US yields higher. Plus, of course, Donald Trump returning to the White House with his policies prioritizing growth over debt. That's exacerbating the situation, and investors are becoming increasingly fixated on fiscal and budgetary decisions and what that might mean for markets and the Fed. So all of these developments have contributed to, for example, the 10-year notes alone soaring more than a percentage point over the past few months. And it's now within sight of that important 5% barrier. And this is important because apart from a brief moment in 2023, that 5% barrier hasn't been seen since before the global financial crisis nearly a couple of decades ago. And in terms of the repercussions, like you say, well, firstly, of course, households, businesses, they're going to find it more expensive to borrow. US mortgage rates are already back at around 7%. Stock investors are already beginning to fret that these higher yields are going to be a bit of a poison pill for the bull market. But in terms of the currency market impacts, we are already seeing some meaningful consequences, not just the strong US dollar continuing its tear from the end of last year, but a significantly weaker pound. And that's despite the fact that UK gilt yields are also rising in lockstep with US yields. We're seeing a weaker pound as a result of that.
Yeah, that's right. I was going to ask about the situation in the UK because that's been at the epicenter of the bond market news recently, hasn't it? Gilt yields rising sharply, but the pound falling has raised the inevitable comparisons with the 2022 gilt crisis. Do you think we're on the cusp of a new crisis here? Where's your mind?
Yeah, exactly. I'm glad you brought that up because obviously, being based in the UK, this is something I'm paying close attention to, and I think at this point, the moves that we've seen in UK gilts and UK assets haven't been as aggressive as what we saw in 2022, the Liz Truss moment where that mini budget drove a lot of amplified volatility. And the drivers of the moves that we've seen this time around look different. And plus, there's no evidence of financial stability issue that's going to trigger any intervention by the Bank of England at this stage. So all in all, it's not as damaging or unstable as it was in 2022. I think really, the sell-off that we're seeing in gilts that push yields higher can be explained by two main factors. Like, firstly, the scaling back of the global rate cutting expectations, and that's been driven by the Fed, as I mentioned earlier. But perhaps most consequential for the medium term is the domestic concerns over the evolution of the monetary and fiscal policy mix. So the UK's set of fiscal circumstances, they seem to be aggravating or accentuating the market's concerns with serious debt now emerging around the government's fiscal strategy. So essentially, what's happening is investors are losing faith in the UK government spending and growth plans, and that's prompting them to demand a greater risk premium to own UK debt, i.e. those gilts, and that's leading to higher yields. And the higher the yield, the bigger the problem for the government and the worse the problem for the pound, especially in this environment that we have in the UK of growing stagflation fears, which is simply weak to no growth coupled with sticky inflation. So the UK Chancellor faces three difficult choices: whether to cut spending, increase taxes, borrow more in the market. I don't think that the latter is likely at all. So for the sake of preserving an orderly market, we do think that the Chancellor is most likely to make a statement about addressing spending commitments. And that should ease some of the inflationary pressures expected from government spending. And therefore, it's more probable that the Bank of England rate expectations in the very short term or on the very short end, can move a bit more dovish. So in summary, a fresh crisis akin to 2022 is not our base case at all. But we have turned more negative on the pound as a result of all of this.
Interesting to hear. So on the pound's fortunes, some more here. It's been the worst performer among the G10 currencies so far this year. Given that, are you seeing any signs of respite or relief on the horizon from that position?
Yeah, you're right, Alex. The pound has been pounded, as we say over here. It's been sold off in quite dramatic fashion, losing value along with UK gilts. And that's created this unusual disconnect, actually, between yields and the currency. Because usually in an advanced economy like the UK, rising yields typically leads to a stronger currency. But context matters, and rising yields in an economy where growth is so weak or expected to be so weak, and debt sustainability concerns are rising, as I mentioned. This generates this mismatch between rates and currencies. And in this instance, it's dragged the pound to over 1 year lows near 121 against the US dollar recently, despite the fact that the UK US yield spread is rising. And another important factor behind why this is happening is the UK's twin deficit. It's heavily reliant on overseas investors to fund its deficits. And that leaves its assets and the pound at greater risk from capital outflows. I mean, there's fiscal external deficits in the US, which are compelling and structurally negative for the dollar in theory. But the US has the world's reserve currency, and that's an exorbitant privilege that the UK doesn't have. So that leaves the UK exposed to the kindness of strangers. And that's why the pound is, at the moment, it's reeling from the current rise in bond yields that we're seeing. But what's really interesting, I think, for the pound's future is what the FX options market is telling us. Because demand for pound exposure has actually surpassed levels seen during the Truss era back in 2022 and even during the Brexit referendum. And that demand is in the form of protecting against further downside risk in sterling. And these bets are at multi-year highs, even those to protect against extreme tail risk scenarios with a 10% probability of happening, such as sterling US dollar exchange rate falling to the likes of 115 or even 112. Personally, I think this may be a bit too pessimistic for the pound, but the path to recovery does look tricky from here unless we see improved UK economic fortunes, a more credible chancellor. But interestingly, I think there exists this downside asymmetry for the pound in the case of the Bank of England, because a hawkish Bank of England is going to keep yields elevated, exacerbating the current strain on UK gilts and therefore weighing on the pound as it is doing right now. But if the Bank of England turns more dovish, i.e. more rate cuts start to be priced in by the market, yes, this brings back down the cost of debt repayments for the government, and it might initially offer some relief to sterling via stability in UK markets. But the likely shift in the short end of the UK curve is probably going to weigh on the pound as well via the yield narrative. So we think the pound is encountering this kind of lose-lose situation when it comes to the Bank of England's policy path, as it stands at this stage anyway. So then perhaps it's the international front that offers more hope, a weaker dollar. That is, if the narrative towards the dollar turns negative, either via cyclical or tariff-driven channels, that would give some breathing space for risk-sensitive currencies like the pound.
Interesting. So the pound is getting a thorough pounding from best to worst G10 FX performer. Oy. Interesting times in the UK for sure, and signs of elevated volatility across the currency space already compared to last year. Do you think this volatility will continue?
100%, I think so, Alex. We're convinced volatility is going to pick up from the doldrums of the last year or two. And last week was just a glimpse of what this could look like. Not only have we got this global bond rout causing headaches, but the recent tariff headlines that we've seen and Trump's tweets, their impact on market volatility is just a taste of things to come as well. So, I think it's time to strap in for some extended volatility in the uncertain times that lie ahead.
Strap in. Wise words to close this one out. George, thanks so much. A lot to cover in the coming weeks and months. It's going to be an interesting year. Thanks for joining us today.
Thanks for having me, Alex.